You've heard me say, please manage your risks accordingly, but what does that actually mean? Let's discuss the basics. My name is Den Slim, and welcome to another episode of Monday Market Outlook. So the PSEI was all over the place last week. If we look at the charts, we have hesitation weeks here, an overreaction to the US CPI numbers on Tuesday. We have a rejection of this trend line support, and then we ended Friday undecided on where the market wanted to go. But overall, for the whole week, we were up 30 points. We got our pullback wish from our trend line support, and we rallied back to 6,900. So this has been our favorite zone recently, and we may see the markets consolidate along this range as it will be a quiet week in terms of economic data for both the Philippines and the US after the BSP kept its policy rate unchanged last week at 6.5%. But the inflation forecast for 2024 of 4.7 was risk adjusted to 3.9%. So risk adjusted means that the calculation, so they have a method of calculating 4.7%, which takes into account factors like trends in the rice prices, trends in vegetable prices, etc. Now, other factors are put in the mix when we risk adjust, like potential for a Middle East conflict or a potential for an economic slowdown in the Philippines that could cause the inflation read to adjust to the downside. No? But in the meantime, S&P 500 broke its 5-week winning streak, ending 30 points down to end the week at 4,999. Again, aside from the FOMC meetings and the flash PMI announcement and the initial jobless claims, which will not be until this Thursday, it will be a quiet week for economic numbers. But a slew of economic numbers caused some concern last week. First, the US CPI numbers surprised to the upside, coming in at 3.1% versus the 2.9% forecast. And the culprit here was the sticky rental component of CPI, which has managed to stay above 0.4% at least in the past 29 consecutive months, while all other components have tapered down to the 0.01, 0.03 level. Additionally, industrial production unexpectedly edged lower in January. We were expecting a 0.3% increase month on month, but instead we got a negative 0.1% read in January, supposedly because of the winter weather. Now, this will add to the bear case for a recession, because if we look at this chart, 8 of 9 times that we've hit this line here, the economy entered into a recession. Additionally, retail sales numbers also tumbled down negative 0.8% on a month-on-month basis, which is much worse than the negative 0.1% forecast. And even the year-on-year computations were significantly down. So, taking a step back here, we've been getting very resilient labor data from the US. But at the back end of all of that, industrial production is down. CPI numbers are up. Retail sales numbers are down. So there's something not right here, especially after the fact that there's still excess spending in the US economy, which is supposed to be good until 2024. But I guess it was really about the frigid temperatures that prevented Americans from spending more than they should, and also prevented manufacturing to perform as it was expected. But despite that, expectations of a global recession has gone down significantly in the past months to its lowest level since 2022. And the growth expectations for a stronger global economy in the next 12 months has actually been steadily improving in the past 2 years. Now, if we look at the fund flows, emerging markets are suddenly getting a massive influx of funds in the last few weeks. So if we look at our watch list of Philippine stocks, we can see the winners, Monde, ICT, RCR, topping the list. So maybe these funds may have found their way into these stocks as we've seen a great deal of foreign inflows enter into the Philippine markets recently. Now, a quick look at the Hang Seng Index as we wrap up the Chinese New Year. We continue to see a good base formation here. But again, the Chinese markets usually become bullish after the Chinese New Year. So could we see this continue for the rest of the year? Goldman Sachs came out with a couple of new themed ETFs called the K-Pro and the K-Buff, no? And these ETFs are mainly composed of China tech companies. Now, ETFs like this usually come out when analysts anticipate a market bottom. So look here, when Goldman Sachs initiated a new ETF back in October 26, right when the market bottomed. For the S&P, last week we did see a reversion to the mean. The 20-day EMA continues to hold, no? And again, we anticipated a pullback and a retest of the 5,000 resistance. But the volatile triple options expirations last Friday was enough to cause the markets to close on the downside. But if we look at the Nasdaq, we see here that the trend is intact. So this is the 2-hour chart. This trend line still holds. And for the bulls, pullbacks like this will always be buy the dip opportunities as long as this trend holds. The bears, on the other hand, argues that the more times you hit a support level, the more likely it is to break. So we will see how the markets react this week when it opens on Tuesday, as the markets will be on holiday on Monday because of President's Day. But beyond the Nasdaq, if we look at the weekly heat maps, no, we do see a clear rotation out of tech. It may no longer be the Mag 6 who will drive the markets this week and moving forward for 2024, as we again see the Bank of America coming out with the report that the Mag 7 is projected to have a slowdown in growth, while the S&P 493 instead may beat the Mag 7 in terms of their expected growth earnings. In the meantime, if we look at our seasonality charts, investors and traders are anticipating a possible topping in the markets. As we've been tracking this trend closely in the past months, we see here the green line representing the trend every time a sitting president is running for re-election. But one thing to be careful here is that the pullback here, if it does happen, will also affect, of course, the Philippine markets. And again, we go back to the trend still being intact. We can't predict that the market has stopped until we see more definitive signs that the trend has actually reversed. For next week, earnings will be exciting as Nvidia will report on Wednesday. The Nvidia stock has been on a tear. So could this be a further hurrah from the Mag 7 leader Nvidia, as the implied volatility for Nvidia could be a potential 11% move either way. For this week, I'd like to talk about a very important concept in stock trading or investing. If you've gotten stock tips from your broker or maybe from an internet personality, and you notice that when you buy the stock, the price goes down, you're now left scratching your heads and you don't know how to manage that loss. Eventually, you lose confidence in that broker or that person who recommended those stocks. No? Now, it is very easy to ask someone what's a good stock to buy. They can give you great stock recommendations. But the most difficult part in trading and investing really is when to exit a trade. And this is what a lot of traders cannot manage properly. You've been hearing me saying, please manage your risk accordingly. And I think it's time to discuss that. And this is the reason why successful traders may have more failed trades than their successful trades, but at the end of the day, they still earn money. Let's look at some trades that we did last year. Now, if you remember, we initiated some swing trade suggestions for BPI. Now, we noticed that BPI was on an upward trend. We have a pullback here, an upward trend, pullback, a rally, and a pullback. So, we had a good basis for expecting that this trend will continue. So, we entered a suggested trade here. Now, remember, when you enter a trade, always define a stop loss and a target price. Even if you are trading for the long term, there should be a stop loss price, right? Now, in this case, for BPI, we entered at 103 after we confirmed the bounce. So we don't enter here. We watch for its reaction here. And if it reacts positively, then we enter. Don't predict. We enter here at 103 and we put a stop loss here at 99, below the support. If we follow this trend channel, the potential upside here could be up until 117, right? Which also corresponds to a previous resistance level. So if we measure this, if assuming we are investing 100,000, if we measure this, this is a potential loss of 4.2%, which is 4,200 of 100,000, but a potential gain of 13.4%, which is 13,000. This is called the 1:3 risk-reward ratio. Always enter a trade where the upside potential here is 3 times the downside potential. Now remember, there is no guarantee that the trade will be successful. If the market was easy to predict, we would all be rich. But no. But it is a different beast. So we have to be able to manage our risk accordingly. Right? So even if there's a big chance of success, we always prepare for the unexpected. And in this case, we set a stop loss here where this means that it has broken support. Now, this trade went all the way up to 118. And we exited this trade at around 117.50. So this was a good trade. Now we got another pullback here, right? We got another pullback here and we said, okay, could this be another potential swing trade? So we entered at around 109 and we set a stop loss here at 104. Take profit is at 120 to 124 and look at what happened, right? The trade failed. We initiated another swing trade for JFC because we noticed that it was hitting 260 and it was always supported at around 209 and even at 200. So every time it hit 210, 212, we entered it and exited at 260. So we initiated the swing trade here. We said enter JFC here at 215. We put a stop loss here at 203. Now when a stock reaches a support zone, don't buy into it. Wait for its reaction. In this case, it even went further down the support, but it went back up. So okay, we initiated that trade. This is a trade that had a 6% risk, but a potential upside to 260 of 20%. So again, 1:3 risk reward ratio. And this trade worked for us. It even reached 265. Now next, we had RRHI. RRHI was a promising stock. It was a fundamentally good stock. But look at what happened here. So we were expecting a double bottom here. So we entered at 51 and a stop loss here at 49. Our take profit was supposed to be here at 60 or 62, but look at what happened. It went down. So it hit our stop loss and we exited the trade. The trade failed. Now, if you held on to that trade and you're arguing, some people argue about paper loss. I mean, it's just a paper loss. Don't sell it because it will become an actual loss. I mean, this could happen. This could happen, right? So you don't want that happening. You've already said that it broke support here, and actually this was a bad trade because if we look at it, the trend was still going down and there's no reason to believe that it was going to form a higher high. So unless that happens, you have to put a stop to your losses. Don't continue to build on your losses. Price action is still king. Even if it had good fundamentals, it didn't matter. It was still trending downwards. And even here, even if we thought this was forming a base, it still went downward. Now, is it forming a base? We can't say until it actually hits this level and actually breaches that level and actually forms a more definitive reversal of trend. As of now, we've had 2 successful trades and 2 failed trades. So, break even, right? No, we didn't break even. So, let's look at our trading journal here. We've had 2 wins and 2 losses, right? BPI, 1 win, 1 loss. JFC, win, and RRHI was a failed trade. But look at the result, right? If we invested 100,000 for each of these trades, you would still be up 26,000 despite those 2 losses. Even if you made more failed trades, despite having 2 wins and 6 losses, you would still be up, right? And that is really the essence of risk management. And even for long-term investors, make sure to define a stop-loss point. Now, let's look at Monde here. If you were investing Monde for the longest time, right, it kept on breaking support levels. Look at these support level breaks. There's a support level here, it broke. There's a support level here, it broke. Support level, it keeps on breaking support levels. Peso cost averaging down. For me, that's a flawed strategy. Don't add more money to positions that continues to lose. Exit the trade. That's what risk management is really all about. That's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. And I hope that you are now able to manage your risk accordingly. And I'll see you again next week.